Okay, so my name's Alan Blair. I'm the founder and CEO of REI Capital Growth, and we reinvented real estate investing for the digital age, which I will talk about a lot in a minute. But a brief summary of my career and my background to give a little context. My first career was as a Marine Corps officer and a gentleman and a naval aviator flying helicopter for the Marine Corps up and down the coast of California and in Korea. And when I exited active duty, I went into business with my father, and we owned and managed apartment buildings in New York City, the Bronx to be specific. We owned about 200 units, up to about 350 at one point. And then I did that, owned, managed, operated for about 20 plus years. And then we escaped New York City, and via several 1031 exchanges and moving to different states, different asset types, I wound up really getting involved with multi-tenant retail properties around the United States. And for the last 10, 12 years, I've been an issuer of single property securities for single property deals with multi-tenant retail for the last 10, 12 years. And we currently have about $30 to $32 million of assets under management, where we do the whole things, just like Gary Brandeis was talking about earlier, right, from raising the money, acquiring the properties, analyzing the properties, managing the properties, from soup to nuts. So what do I mean by reinventing real estate investing? Well, in a forum like this where we're surrounded by a lot of high-tech folks doing all kinds of innovative technology things with venture capital floating around trying to create this new ecosystem, I'm not talking about anything high-tech. This is low-tech. We're talking about the other side of the equation as it relates to real estate. Because as we've been hearing and saying all morning and all forever, real estate is not high-tech. Real estate is real estate. It doesn't change. And so this is more of a innovation on a low-tech side with regard to the business model of real estate. All real estate deals that everyone's familiar with have a similar model. But this model represents a synergistic relationship between the two funds that we've launched. REI Capital Growth is one fund designed to offer investors growth, and REI Capital Income is designed to offer investors income. Now, we are not a startup. We're a bunch of seasoned professionals that have been doing exactly the kind of real estate that we propose for these funds for the last 10, 12 years, and plus I've been doing this for 30 plus years. Think of us kind of like a SPAC. It's kind of a special purpose real estate acquisition fund, if you will. You've never seen a real estate fund like this before. So what are the differences? All traditional private real estate, or even public real estate deals for that matter, have a similar business model. They all offer a single security, an equity security, with the promise of income and growth. What? Just switch on the mic. I turned, it's on. Can't hear me? How's that? All right, we'll go with that. So the problem with traditional real estate business model, with that single equity offering, is the income side and the growth side all rely on a certain prediction for the future. The growth component always involves a prediction in the future. You're predicting a turnaround, or you're a developer, you're building something and you're predicting what you're going to sell it at when it's stabilized in the future. And the future is inherently not very predictable. So I set out as a problem solver to try to come up with a solution that was much more predictable. And as we all know, within this last 2 years with COVID, the income component of traditional real estate has turned out to be not that fixed income, as they like to refer to it. So our model is different. We redesigned the business model of the real estate to solve for problems. Both of our real estate funds are, I think I'll stay back here first. Missing a page. Okay. Most of our real estate models are designed as evergreen funds. I saw Richard from Texture wrote an article earlier this year about it's time for an evergreen fund, but he was referring to venture capital. Well, it's time for evergreen funds for a lot of reasons for real estate markets. And the reason for that is everybody wants liquidity. You can't have liquidity with a real estate model where you have a 3 to 5 year holding period and then you sell for a liquidity event for your investors, and then you start all over again. It needs to be able to trade the way REITs trade on Wall Street on these exchanges. So you need a permanent business. And what we did is we separated the income component from the growth component in our two different funds. And there's a lot of good reasons for that, primarily around overcoming the huge obstacle and blockade of the IRS. You know, we have a room full of lawyers, SEC lawyers and technology providers, and their compliance with that, with all the, but nobody's thinking about the IRS. The IRS is a huge blocker to cross-border trading. And nobody's really thinking about that. Well, we've thought about it. So we created our two funds, REI Capital Growth, designed to grow investors' stock value consistently, mathematically, in a compounded fashion year over year over year. And it is not correlated to the changing prices of real estate. I like to buy stabilized real estate. These funds are based upon stabilized real estate. I'm not a developer, I'm not creating value. I want to acquire real estate that somebody else has created the value and then had to sell it in order to create a liquidity event for their investors. I want to buy cash flow streams. I want to buy stabilized cash flow streams. It's a business. Our model change, if you will, essentially is the fund is structured like an interval fund, wrapped in a permanent capital vehicle. Gary Brandeis was talking about a permanent capital business model earlier today. Well, Here it is. It's structured, the most famous company that's structured similarly to this is Warren Buffett's Berkshire Hathaway. He does not offer dividends. There's no distributions of profit. What he does is he buys profitable businesses, he reinvests that profit, and buys more profitable businesses. Well, why can't that business be a real estate? Stabilized real estate. You know who your customers are, your tenants. You can read the contracts. You can analyze whether they're good customers or not. And you can very predictably estimate the NOI for the next several years. That's the business model for the REI Capital Growth. However, a lot of people do want to invest in real estate for income. Hence, REI Capital Income. And what that does is it sells bonds. It sells bonds to people who want income. And the purpose of the synergistic effect of the two funds is that REI Capital Income replaces the need to borrow from banks. And if you think about the way things work with regard to equity and debt, if you're an equity owner, you're an owner. And if we're all business owners here, we all understand business, when there's a problem, for example, a global pandemic, who gets paid first and who gets paid last? Owners get paid last. Your debt gets paid first. So we decided that we were going to offer bonds in a separate fund, so that way we could borrow from people who want stable income. And we'll pay them interest. It doesn't have to be profits distributed, it just will pay them interest. And there's a lot of really important tax reasons why that works for the digital age. And I encourage you to come to our website and check out the short little videos we created. It really articulates the differences in a very pleasant way and helps you to understand the differences between traditional real estate and the reasons why it makes sense. Now, we are currently live with both of these funds as a Reg S only. And Vitalo is our investor onboarding vendor, so to speak. However, we just initiated our auditing process, and we should be filing for 2 Reg A pluses here in mid to early October, with the goal towards being able to go live with a Reg A pluses in January. Now that's important because we feel that in order to achieve liquidity, a real estate fund needs to have a lot of small investors rather than what almost all private equity does, is having a small number of large investors. And there's a lot of IRS and SEC reasons for that. Once you have more than 2,000 investors, whether you're private or not, you are now an SEC reporting company if you have over $10 million of investor capital. So we decided to just go that route from the beginning. We will be audited. We will be an SEC reporting company because we intend to have more than 2,000 investors and small investors. And there's another reason for that, in order to attract new markets, new investor markets. Now, the advantages, the inherent advantages to the business model changes that we've created. Well, there's the natural real estate advantage, and that is when you talk to some of the real estate folks around here, everybody realizes that for the last several years, cap rates or real estate prices have been peaking and floating right around the top prices that we've seen for the last 10 years. One type of real estate over another, maybe 10, 8, whatever. And interest rates are as low as they've been forever, and nobody anticipates interest rates going lower, and nobody anticipates prices going higher, because the only reason to invest is because of the spread between cap rates and interest rates. And that's been squeezed pretty much at this point. So to offer investors a growth product that will grow in value year over year in a very programmatic way is something that the only other place to get growth is with a developer, with somebody who's adding value. But as we said, that's inherently risky. So that's one advantage. The offering of income via a bond product that serves as the debt for the acquisition of the fund is just replace the bank with investors and have a very stable income stream to the investors who want income. They get paid first. It's not really complicated, but there's a couple of other advantages to this structure. And when you talk to the Alto IRA folks, you can realize with the problem why private real estate deals can have, the problem they have accessing qualified funds is a couple of terms called unrelated debt financed income, UDFI, and or unrelated business taxable income, UBTI. Because even though your IRA, 401k income into those qualified funds are not supposed to be taxable, well, big surprise, when you use debt-financed real estate dividends or distributions, the proportion that is financed by debt is taxable even in your IRA. And the tax rate is a lot higher than your regular tax rate. It's horrible. That's the reason why a lot of the big wealth management firms like Wells Fargo or some of the other big firms, they won't get involved with self-directed IRAs. The others, Altos of the world, they leave it up to the responsibility of the individual to figure it out and their tax attorneys. So this business model, both for growth and for income, avoid that completely. And as a public company, even though it's not traded as a public company, opens up the market to the IRA world, wealth managers, registered investment advisors, et cetera. It's all about setting up the model in order to access additional investors and additional access to capital. So the tax simplification strategy. This is a byproduct, if you will, of the business model. So all of these real estate security token offerings, they want liquidity. They want international liquidity. We just heard of all of the exchanges that are going to be traded internationally. Well, you can't. So the rules with the IRS with regard to profits are when you distribute your profits via a distribution or a dividend, you have to have the investor's tax ID, and you send Uncle Sam a 1099. Well, what if you don't have a tax ID because the investor is a non-US citizen? You have to give Uncle Sam 30% of whatever your distribution is. And that investor is never going to see that money again because he's got to hire a lawyer and file tax return and try to get some of it back. And they never do. So the fact that our growth fund does not offer dividends or distributions solves a lot of problems. Now I can take investors from anywhere in the world and their stock value in the fund will just grow year over year over year. And when their stock value grows to a point where they want to sell or trade, that's a capital gains event in their country. That's not a taxable event in this country. The companies, by the way, will elect to be taxed as a C Corp. So we're paying taxes at the corporate level, which, by the way, is a lower tax rate than the individual tax rates. So it's a very tax-efficient business structure. All right? And it also means that our equity shares in the growth side can trade friction-free internationally for cross-border trading. There's no obstacles. On the debt side, our bonds are designed to comply with an IRS exemption to the 30% withholding. If I borrow money from an individual from overseas, from outside the US, and it's a simple interest principal. When I pay that person back interest, that's interest income in their country. I don't have to withhold 30%. And our bonds are designed to accommodate that. Which means our bonds can trade cross-border friction-free. You can't do that with equity. Now, it is true that a lot of the big wealth funds, and they've established offshore feeder funds and tax treaty accounts for the international folks that want to avoid the U.S. tax regs, and that's fine for them. But that's not fine for small individual investors all around the world. We want to make this accessible to individual investors all around the world. And in the U.S., by the way. So that gets to the liquidity portion. Our business model eliminates the huge blockade that the IRS represents to cross-border trading. And it expands the entire universe of potential investors that we have access to. It's just a simplified tax structure. The chances of the government changing the tax laws to make this not work are slim to none. They may change the tax treaty laws, but they're not going to change the rules about wanting taxes on profit. Right? Now, the fact that we're not distributing all the income every year means that as we grow the size of the fund year over year over year, we're going to have an immense amount of cash flow every year. And within a few short years, we'll be able to offer additional liquidity by creating setting ourselves up as our own market maker. In addition, we also set the fund up for the initial years to offer a redemption program. So that way, even in the early years, our investors will have some liquidity supported by a redemption program. And the funds are designed to be completely scalable. We will be continuously raising capital year over year over year, because the larger the fund gets, the better it's going to work. We need scale in order to operate. So I decided I wanted to add, and now the rest of the story, a little personal note about the history. My mother and father were both born in Jamaica. And they immigrated to the United States in the 50s, 1950s. I was born in 1955, first member of my family. And before they came to the States, they wrote themselves a little goal, little letter of prayer, so to speak. And it was their American dream. They wanted to educate their children, to buy a home, and start a business. Same American dream that people have all over the world, from different levels. And most people who achieve their American dream achieve it with real estate. And that's what they did. And that was my aha moment. What our funds are doing is offering the American dream to people all over the world. And they can invest passively. And they don't have to immigrate to the United States in order to do it. That's the goal. That's the mission of our Reinvented funds. But as with most things, there's a catch. The catch is we need scale in order to make this work. You can't get to $50 million or $100 million worth of assets quickly by raising $5,000 an investor as a minimum investment. We would like to lower it down to $1,000 minimum investment per investor. So we decided we needed to try to attract some lead investors, some large investors who agree with our real social impact. We really want to have a social impact that works, that helps people to invest internationally and improve the lives of their families in the long run. So we decided to offer lead investors, large investors, $1 million or up. We need to achieve a minimum of about $20 million quickly to launch the fund, to have operational income, so that way we can announce to the world the success, have a couple of quarters of production, so that way we can show that it works, and establish a massive PR campaign, publicity campaign, let the world know that we've built a better mousetrap, so that way people will beat a path to our door. So in order to attract some larger investors as soon as possible, we decided that we would offer them a bonus to what everybody would get. And that bonus would be a 25% participation of our sponsor promote. Our sponsor promote is a performance reward of equity that we've created. We had to create it because we don't plan on selling the assets in order to create a liquidity event. We're going to hold the assets forever. So we created a performance reward where we're projecting 8 to 9% compounded growth annually on the equity side. So our performance promote is 1/10 of that growth, or 10 bips of the growth, starting in year 4. Will be units of equity granted to the sponsor. We'll share 25% of that with our lead investors. And the result of that is pretty profound. So the blue represents equity. So we're asking our lead investors to invest half in equity, capital growth, and half in income in the bonds. The blue represents equity. The equity will double in 10 years. The green represents the 6.3% total yield on the bonds. By the way, the bonds, we're offering a 5.5% coupon, simple interest coupon, and we're paying out 4% quarterly. The difference between the two will accrete or accrue to the principal balance, which will in turn earn 5.5% on the coupon. And when the investor decides they want to sell or trade or hold to completion, the total yields 6.2 something percent. The red represents the bonus equity that our lead investors will get. And you can see, I'll say it, instead of doubling your total investment in 10 years, it'll triple the total investment in 10 years. And the larger the scale, the larger that number will get. So we're looking for lead investors to start up and get us going, $20 million or more, $50 million, it will scale. And then we'll cut it off and work on regular investors all over the world. So we are a small team of owners and professionals, and I have a larger network of team that will be working with us in acquisitions and management. And for our lead investors, I do have a 40-page thesis that articulates all the details, all the nuts and bolts, why it works, how it works. And I'm happy to share that with any lead investors that can be referred to me. And some of our friends and partners here at Vitalo have introduced us to some heavy hitters that may be interested. We're scheduling meetings. Gary Brandeis, John Nance from Dealbox, and Alan introduced me to somebody the other day. Thanks, Alan. So if you got any ideas, if you got any leads, any investors or family offices or anybody that you think might want to participate in this to help achieve that real social impact globally and get liquidity going, there's no better opportunity to have international, robust, cross-border trading in real estate than my two funds. Thank you.